The European Union has imposed another package of sanctions against Russia, which also affects the energy market. Nevertheless, oil prices remained unchanged, although trading activity increased markedly. Apparently, investors have taken a wait-and-see approach. The new package of sanctions affect petroleum products previously supplied from Russia to Europe, and this refers to commodities that are of crucial importance in construction roads. Obviously, now Europe will have to seek alternative suppliers, thus rebuilding supply chains again. Notably, the energy market has not yet had time to adjust to all previous sanctions packages. All this will add to uncertainty and confusion over foreign trade, which in turn will inevitably lead to higher prices. Investors are in no hurry to take risks ahead of time and prefer to wait for statements from Russian officials. There is no doubt that the Kremlin will respond with retaliatory measures. However, it's not yet clear what they will be. This keeps the market relatively stable. Nevertheless, the growing influence of political factors on the energy market will inevitably contribute to a gradual rise in oil prices. Last week, Brent crude oil futures slid to nearly $80 per barrel. As a result, the volume of short positions decreased. Later on, the asset pulled back, gaining about 3.5%. To resume a downtrend, the quote needs to stay firm below the 80 mark. Otherwise, a continued rally is possible, given that the new package of sanctions from the West fell on a holiday in Russia, and there has been no official response yet. Moreover, Russia usually takes at least a few weeks to introduce retaliatory measures. The very fact that Western countries are turning up their pressure on Moscow is a negative factor for the ruble. So it came as no surprise that the dollar advanced to 76 rubles. At the same time, the ruble's weakness was mostly due to steps taken by the Ministry of Finance, which brought the Russian currency into oversold territory. Therefore, any statement from a Kremlin officials regarding possible retaliation will be enough for the ruble to post some gains. From a technical point of view, the dollar hit a new local high, reaching the 76.5 mark. In that area, the volume of long dollar positions decreased, which led to stagnation, followed by a pullback. And now, if the price fails to consolidate above the level of 76.5, the Russian currency may well enter an upward correction. Rising geopolitical tensions should have contributed to higher demand for traditional safe haven assets. However, gold fell to almost $1,800 per troy ounce. Over the past week, gold futures lost 1.7%, noting the fourth consecutive weekly dip. Amid such heavy losses, the yellow metal could dive into oversold territory. This, in turn, may cause stagnation or a technical pullback. The thing is that current events indicate the critical importance of commodity assets and their supply chains. This forces market participants to resist the holdings of traditional financial instruments. Over the past year, the value of seemingly familiar things has often proved well above that of gold or other traditional safe haven assets. The very fact of such a rethink of modern realities continues to exert pressure on the yellow metal. Moreover, this pressure will persist for a long time. However, certain events will surely lead to local surges and a noticeable rise in gold prices, albeit short-lived. And that's all for now. We wish you profitable deals. See you on our channel with a new video in a couple of hours.